Welcome to today's deep dive. It is Monday, July 27, 2026, and today's session is actually specially curated for the Insurance Study Companion.
Yeah, we've got a really foundational one today.
We do. And, whether you're a CPCU student, an insurance professional, or just like a beginner trying to figure out how this massive industry works, this is crucial. We are tackling the concept of the insurance broker.
Right, which sounds simple on the surface, but it really trips people up.
Exactly. I mean, think about it. You're sitting across a desk, right? You're about to hand over tens of thousands of dollars in premiums for this new commercial policy. The person smiling on the other side, they slide this polished contract across the table, hand you a pen. But before you sign, you have to ask yourself one critical question.
And it's probably the most important question you can ask in that room.
Right. Who is that person across the desk actually working for?
Yeah, because, the natural assumption is always, well, they must work for the massive corporation whose logo is printed right at the top of the paperwork, right?
Which makes total sense. But that assumption gets a lot of people in trouble. I kind of like to think about it like navigating the real estate market.
Yeah, sure, that's a great analogy.
Yeah, like if you walk into an open house, the agent standing in the kitchen handing out those glossy flyers, that is the seller's agent.
Right, they represent the person selling the house.
Exactly. They are legally bound to get the absolute highest price and the best possible terms for the seller. But if you want someone to ruthlessly negotiate for you, to spot the flaws in the foundation, drive the price down, you don't rely on the seller's agent. You hire a buyer's agent.
Yeah, and in the insurance world, we are basically looking for that buyer's agent.
Right. Which brings us right to the actual definition.
Mm.
So what is the ultimate distinction between an insurance broker and an insurance agent?
Well, it all comes down to legal representation. By definition, an insurance broker is an independent professional who represents the insured. So, the buyer.
The buyer, right.
Yeah, they do not represent the insurance company. Contrast that with the insurance agent, who is essentially, going back to your analogy, the seller's agent. The agent represents the insurer, and they're appointed to sell that specific insurer's products.
Okay, so for the CPCU students and professionals listening right now, the source material actually gave a really simple mnemonic device for this. It's the B rule.
Oh, yeah, the B rule is a lifesaver on exam day.
It really is.
Yeah.
It goes like this. B equals broker. B equals buyer. B equals best market search. So broker, buyer, best market search.
I love that because that search function is, well, it's incredibly intuitive when you think about how we buy almost anything today.
Like the travel website analogy from the sources.
Exactly. Like if I want to book a flight, I can just go straight to Delta's website. But if I do that, I am dealing directly with Delta's representative, their agent, and they're only going to show me Delta flights.
Right. They're not going to be like, hey, United has a cheaper flight down the street.
Exactly. But if I use a travel aggregator, like Kayak or Expedia, to scrape every single airline in the world to find the best route, that aggregator is operating a lot like a broker.
That makes so much sense. But I feel like there's a catch here. The travel aggregator is just a search engine. A broker has to be more than that, right?
Oh, absolutely. The legal reality goes so much deeper than just, hitting search on a database. In insurance, the dividing line fundamentally hinges on a legal mechanism called fiduciary duty.
Okay, fiduciary duty. We hear that term thrown around a lot, right? In wealth management, law, things like that. But mechanically, what does that actually mean for an insurance broker?
Mechanically, it means the broker is legally obligated to act in the utmost good faith, strictly in the best interest of the buyer.
Wow. Okay.
Yeah, it creates a very heavy legal liability. So say a broker fails to identify a critical exposure, like they don't realize your new warehouse is in a flood zone, so they don't recommend flood coverage.
Oh, I see where this is going.
Right. Hurricane hits, the warehouse floods. You don't just have bad luck in that scenario. You actually have a legal claim against that broker.
Because they failed their fiduciary duty to you.
Exactly. Because of that duty, the buyer can sue the broker for malpractice. And the broker's own errors and omissions insurance, their E&O policy, has to step up and pay out. Their duty is to protect you, and if they fail, they are legally on the hook.
Whereas an agent,
conversely, owes their primary fiduciary duty to the insurer they represent. Depending on the jurisdiction, of course, but that's the general rule.
wait, I have to challenge something here, because this seems like a massive contradiction to me.
Okay, let's hear it.
If the broker legally works for me, the buyer, and owes me this intense, heavy fiduciary duty, why don't I pay them an hourly retainer like I would a lawyer?
Ah, the commission question.
Right. In almost every case, isn't the broker still getting paid a commission by the insurance company when I buy the policy? How is that not a massive structural conflict of interest? I mean, they're getting paid by the seller.
You've just hit on the exact friction point that regulators and the CPCU exams frankly focus on very heavily, because it does seem entirely contradictory. The broker represents you, but their paycheck comes from a percentage of the premium paid to the seller.
It sounds like a total scam when you say it out loud.
It does, it really does. But the mechanism that keeps this legal is strict statutory regulation regarding commission disclosure and transparency.
Okay, so they have to tell you what they're making.
Right. In many jurisdictions, a broker must explicitly disclose their commission structure to the buyer if requested. And more importantly, they are strictly prohibited from steering a client toward a worse policy simply because it pays a higher commission.
Ah, because if they did that, they'd be breaking that fiduciary duty.
Exactly. They breach the duty, they risk their license, and they face those severe E&O lawsuits we just talked about.
Okay, so the commission is really just like an administrative mechanism for how the money moves around, but the legal loyalty stays with the buyer.
Precisely. The legal representation remains firmly with the buyer.
That makes the stakes so much clearer. So knowing they have this legal sword hanging over their heads, what is the broker actually doing behind the scenes?
A lot more than just filling out forms, I can tell you that.
Right, because we know the basics of the insurance life cycle, right? Underwriting, pricing, claims. But how does a broker's execution of underwriting actually differ from, an agent just handing me an application?
I like to describe it as passive versus active representation. A captive agent, they take the data you provide, fill out the insurer's specific forms, and submit it. It's passive.
Okay.
But a broker actively interrogates your risk profile before the insurer ever even sees it. They know exactly how underwriters think. So let's say your business handles hazardous materials.
Always a fun one.
Right. A broker doesn't just, check the hazardous materials box and cross their fingers.
Because that would probably just get you a massive premium spike or a denial.
Exactly. Instead, they gather documentation on your state-of-the-art ventilation systems, your rigorous employee safety training, your flawless 5-year track record. They craft a comprehensive narrative.
Oh, so they're basically doing PR for your risk.
That's a great way to put it. They paint the absolute best and most accurate picture of you to the market, mitigating the perceived risk.
Which naturally feeds right into the next phase.
Yeah.
Pricing. Because they aren't captive to one specific insurer, they can take that highly polished risk narrative and leverage it across multiple markets to create competition.
Exactly. They make the insurers fight for your business.
But let's talk about the result of that competition. Because when a business approaches a broker, I feel like the mandate is usually just, hey, lower my premiums.
Oh, almost always.
So is the broker's fundamental goal just to find the cheapest possible policy on the market?
No, and that is a very dangerous misconception. Their mandate is finding the optimal intersection of price and protection.
Because cheap isn't always good.
Right. The cheapest policy on the market is fundamentally useless if it contains, say, a hidden exclusion for the exact peril your business is most vulnerable to.
Oh, wow. Yeah, that would be a disaster.
A broker analyzes the nuanced policy conditions, the sublimits, the deductibles, the definitions of covered causes of loss. They are tasked with ensuring the parachute actually opens when you pull the cord, not just that you bought it on clearance.
I love that. Ensure the parachute actually opens. And when you inevitably have to pull that cord, when the loss actually happens, we move into the claims phase.
Right, the moment of truth.
So the insurer is the one holding the checkbook.
Right.
So they settle the claim.
Yeah.
The broker is still heavily involved here, right? They essentially act as a translator for all that dense policy language.
A translator, yes, but also a highly aggressive advocate. When a massive loss occurs, the insurance company is going to send out their loss adjusters.
And those adjusters work for the insurer.
Exactly. So the broker steps in to manage the communication, ensuring the claim is submitted precisely according to the policy conditions to avoid any, technical denials.
And if the insurer tries to push back?
If the insurer trying to interpret some gray area in the policy language to deny a portion of the claim, the broker leverages their technical expertise to fight back. And frankly, they leverage their firm's relationship with that insurer to advocate for coverage on the client's behalf.
Man, it really is a different dynamic. To really see how this intricate balance of price, protection, and advocacy comes together, I want to move away from theory for a second. Let's walk through a real-world commercial application.
Okay, let's do it.
The sources outline a mid-sized manufacturing company scenario. And I think this is where the broker really evolves from just a salesperson into something much more complex.
Oh, the manufacturing sector is a perfect crucible for this. So imagine a company that machines precision metal parts. The exposures there are massive, and they're highly varied.
Right, they have, what, millions of dollars in physical equipment?
Exactly, so they need robust property insurance. Plus, their parts probably go into automotive assemblies or aviation, meaning they have severe product liability exposures if a part fails. So they need specialized general liability.
And nowadays, because their entire supply chain and assembly line are probably automated and digitally connected, they're sitting ducks for a ransomware attack.
Right, so add cyber insurance to the list.
So if the CEO of that manufacturing plant tried to handle this internally with direct agents, what happens? They'd have to find a property agent, a liability agent, a cyber agent.
It would be a nightmare. They'd be filling out redundant applications, and they would likely end up with massive gaps where the policies just don't perfectly align with each other.
And that fragmentation is exactly where catastrophic uninsured losses happen.
Precisely. But when a broker takes over an account like this, they don't even start by looking at insurance policies. They start by walking the factory floor.
Really? They actually go to the plant.
Oh, absolutely. They audit the contracts the manufacturer signs with their vendors. They identify that, hey, the outdated sprinkler system in Warehouse 3 is going to cause your property premiums to spike.
Wow, so before they even approach the insurance marketplace, they're acting as risk management consultants.
Exactly. And once they have mapped every single vulnerability, they take that bespoke risk profile to the market.
It feels less like buying a product and more like, I don't know, commissioning a custom suit from a master tailor.
That's a brilliant way to look at it. They aren't selling the manufacturer a prepackaged bundle off the rack. They might secure the property coverage from an insurer in London who specializes in heavy manufacturing.
Okay. Yeah.
Then they place the cyber risk with a boutique tech-focused syndicate in Bermuda and maybe secure the general liability from a standard domestic carrier. They stitch these distinct pieces of fabric together to create a single seamless net.
And I imagine that seamless net requires constant maintenance, right?
Constant. For complex commercial accounts like this, the broker becomes a long-term trusted risk advisor. They conduct deep annual renewal analyses because the business is always changing. If the manufacturer buys a new facility or expands into a new product line, the broker is proactively adjusting the coverage before a gap can cause a financial disaster.
Incredible. Now, because they build these incredibly bespoke, customized programs across multiple different carriers, brokers actually set a very specific legal trap for themselves.
Oh, yes, they do.
And it's a trap for CPCU students on exam day, too. For everyone listening who is preparing for CPCU 500, 520, 530, or 540, the nuances of how brokers operate mechanically in the market are heavily tested.
Heavily tested and specifically designed to trick you if you don't understand the underlying legal mechanisms.
So let's talk about the biggest trap. The most common pitfall in the exams is conflating a broker with an independent agent.
It is such an easy trap to fall into, honestly, because the terminology is terrible.
It really is. The word independent makes it sound like they operate completely on their own, or that they work for the buyer, just like a broker.
Right. And in practice, an independent agent can quote policies from 5 or 6 different insurance companies. So sitting across the desk, they look exactly like a broker shopping the market.
From the consumer's perspective, they are identical.
But you have to trace the line of legal representation. Yes, an independent agent isn't captive to a single carrier. They have contracts with multiple insurers. But legally, they are appointed by those insurers.
Appointed. That's the key word.
Exactly. They represent the companies whose products they are selling. Their primary fiduciary duty flows back to the insurer. The broker, no matter how many carriers they work with, represents the buyer.
So if you're taking the exam and they give you a scenario where an intermediary is shopping among 3 carriers and they ask about legal duties,
you have to look for the word appointed or the phrase represents the insurer to crack the question.
That is such a crucial tip. And that distinction naturally triggers the most important mechanical concept on the CPCU 530 exam, binding authority.
Oh, binding authority. Yeah.
We really need to drill down into the actual mechanics of binding coverage here, because this is where The theoretical difference between an agent and a broker becomes a multi-million-dollar legal reality.
It really does. Binding coverage is the legal power to make an insurance policy effective instantly. It's the authority to look a client in the eye and say, as of this exact second, you are financially protected.
Long before any underwriter has reviewed the final paperwork or the policy is printed.
Right. It is a massive transfer of financial risk created by just a verbal or written confirmation.
Okay, so let's play out a scenario for the listeners. Let's say it's 4 p.m. on a Friday. Our manufacturing CEO calls their intermediary and says, hey, we just closed the deal on a new 50,000 square foot warehouse. I need property coverage on it right now before the weekend.
Classic Friday afternoon panic.
Right. So who actually has the power to say yes and legally bind the insurance company to that risk?
Generally speaking, the agent has binding authority. Because the agent legally represents the insurance company, the insurer has granted them express authority in their contract to evaluate standard risks and commit the company's capital.
So when the agent says you're covered, the insurance company is legally on the hook.
Even if the warehouse burns to the ground at 8 p.m. that same night.
Wow. But the broker does not have that power.
Typically, no. Because the broker represents the buyer, you cannot logically have the buyer's representative unilaterally committing the seller's money.
That makes total sense when you put it like that.
Right. A broker usually must submit the request to the underwriter and wait for the insurer to officially agree to bind the coverage.
Now, this is where CPCU 530 gets incredibly tricky with this concept of apparent authority.
Yes, this is a big one.
So what happens mechanically if a broker, who we just established, does not have express binding authority, gets that Friday afternoon call, gets a little sloppy, and tells the CEO, don't worry, I've got you bound. But they never actually got approval from the insurer. And then the warehouse burns down that night.
That is the ultimate exam scenario right there. In that case, the insurer will likely deny the claim, stating the broker had no actual authority to bind them.
So the CEO is just left with a smoking crater and no insurance money.
Well, initially, yes. And this triggers the exact mechanism we discussed earlier, the E&O malpractice lawsuit. The CEO sues the broker for breaching their fiduciary duty and misrepresenting their authority. The broker's own insurance has to step in to make the client whole.
Okay, but you mentioned apparent authority. How does that change things?
Right, the exams will sometimes introduce a twist. What if the insurer gave the buyer a reasonable belief that the broker could bind coverage? Say the insurer had historically accepted the broker's binders without question for years. That creates apparent authority.
Oh, I see.
In that case, the insurer might actually be forced by a court to pay the claim to the CEO. And then the insurer turns around and sues the broker for exceeding their actual authority.
The legal domino effect there is just staggering. It all comes back to tracing exactly who holds the authority.
Every single time.
And speaking of confusing exam terminology, let's talk about the word producer. I mean, it sounds like someone funding a movie, but the exams use it constantly to trip up students, right?
Producer is the great umbrella term of the insurance world. It is simply a statutory term used by state regulators to describe anyone who sells, solicits, or negotiates insurance.
So it doesn't mean broker or agent specifically.
No, therefore both captive agents, independent agents, and brokers are all legally classified as producers.
So if a multiple choice question sets up a scenario detailing the actions of a producer, it is intentionally hiding whether the person is an agent or a broker.
Exactly. You have to comb through the scenario for context clues, like who are they advocating for? Or are they exercising binding authority? That's how you figure out which set of legal rules apply.
Never assume producer means broker, and never assume it means agent.
Precisely. You must aggressively hunt for the mechanism of representation in the text of the question.
That is fantastic advice. So as we pull all these threads together for the Insurance Study Companion, let's distill this into a really rigid framework you can take into your career and your exams. The foundational rule: an agent, whether captive or independent, represents the insurance company and generally possesses the authority to bind coverage.
And on the other side of the desk, the broker represents the buyer. Remember the B rule. Broker, buyer, best market search.
Right.
They owe a strict fiduciary duty to the client. They act as risk management advisors crafting bespoke policies, and they generally lack the authority to bind coverage without the insurer's explicit consent.
Understanding these mechanics, I mean, it really changes how you view every interaction in the marketplace. You aren't just comparing premium quotes anymore. You are navigating this complex web of legal duties, binding authorities, and aligned interests.
It reviews the hidden architecture of how risk is actually traded.
Which brings me to a final thought I want to leave you with, something that builds on this architecture, but kind of flips the conventional wisdom on its head.
Oh, I like where this is going.
We've established that brokers usually cannot bind coverage because they don't represent the insurer, right? The power to say yes officially belongs to the massive insurance companies.
Correct.
But let's look at the commercial reality for a second. If a massive multinational broker is acting as the trusted risk advisor for a Fortune 500 corporation, if that broker is designing the entire insurance program, steering tens of millions of dollars in premium, and essentially controlling the client's access to the marketplace, how does that deep relationship subtly shift the real balance of power?
That is a fascinating question.
Right. Does the insurance company truly hold all the cards when a massive broker is the one bringing the whale to the table? If the broker threatens to move a $50 million account to a competitor who is really dictating the terms of the policy.
It definitely blurs the lines of who needs who more.
Exactly. It's something to ponder the next time you wonder who is actually pulling the strings in the global insurance market. Keep studying, keep looking for those underlying mechanisms, and we will catch you on the next deep dive.